Rest in peace, housing market. The crash is coming. Get ready for another 2008.
Okay, so if you're anything like us, you've probably literally been hearing this everywhere, right? By the end of this video, you're gonna know whether or not you should buy before the interest rates go up again, or if you should wait for the supposed housing crash.
You might be stuck in a place of analysis paralysis, and that's never a good place to be. Overanalyzing every fear-inducing news headline or Twitter update, or listening to your Aunt Nancy about how the huge crash is coming.
Do you have an Aunt Nancy too?
That can be a lot.
Today, let's move through this question together, both logically and confidently, so that you can take the right steps on whether or not to buy now or wait.
Yeah, over the past 20 years, we've helped our students, people just like you, make moves during times like this.
Look, there's no crystal ball out there that tells you exactly what's gonna happen, when, and where. But there are certain metrics that you can look at in order to make an educated guess. So let me tell you why we don't feel like there's a crash coming. The first data point that I look at is the houses on inventory. Back in 2008, that crash that we all are so familiar with, the crash of 2008, happened because there were over 3 million homes in inventory and a very tiny pool of qualified buyers. We have the exact inverse of that today. Today, we have less than 1 million homes in inventory and a lot of qualified buyers. We've got Gen Xers that are out there right now, like self-made millionaires, very early in life. And that changes a lot of the landscape out there in terms of qualified buyers and inventory. Man, you've got a supply-demand issue still. So I don't think there's gonna be a crash.
I feel like this is like a throwback to our college economics class. It's supply and demand. But it's true, it is.
So likely what's gonna happen instead is a softening of prices, right?
Yeah, in some markets.
In some, yeah. Like you have to understand that when you're seeing those headlines and you're seeing these stories or any kind of video that's out there on YouTube, like you have to understand that blanket general statements about things crashing or prices dropping, it doesn't mean it's like a global level throughout the entire country. There are certain markets where it's not gonna impact that. There are different pockets within the country where it's very lucrative and you can still get up and win in multifamily during this time.
So more realistically than a crash, what we're going to see likely is a softening of prices. Like, oh, should I wait until they're super soft? Sorry.
What does that even mean?
So the real question is, do you buy now or wait? Let's talk about that.
I don't think waiting's a good idea, actually. I just really don't think waiting is a good idea.
Yeah, no, like literally while you're waiting for prices to be exactly perfect at the bottom of the market, like which you could never predict. Our students, people like Teresa and Michael and Rachel and Andy and Maureen and Janice and Bradley, like they are out there making offers and getting things locked up.
And are the interest rates higher? Yeah, they are. It's a fact. They're higher. Are they as high as they were back in the 80s at 18%? No. Are they as high as they were back when we first started at 8%? No. The fact is, no matter what, interest rates are gonna go up and they're gonna go down, and you have to have the right strategy based on where they are and where you are and what your goals are. What was that post? Somebody did a post the other day and I was like, that is rad.
Yeah, a friend of ours said, marry the property, date the interest rate.
That's glorious. And it really breaks it down in the most simplistic form. Like, that's so true. That's exactly what we're doing.
That's exactly what we're doing. And look, all of our students who are out there actively making offers, they're building their financial freedom while other people are literally sitting on the sidelines waiting for like, when are things gonna be the absolute lowest? Who the heck knows? And frankly, time is on your side. The sooner you get in and start building your portfolio, the sooner you're gonna build the financial freedom that brought you to this channel to begin with.
Hey, if you like what you're hearing and you like this, go ahead and subscribe to our channel and hit the like button. It helps the algorithm reach more people just like you so that we can help them. So go ahead and hit that button. No, go ahead. Now, we want to find out from you guys. Let us know. Drop down in the comments. Are you a first-time home buyer, aspiring to be a first-time home buyer, or are you a seasoned pro? All right, so let's get back to it. How do you get into the game with these increasing interest rates? What's the strategy? Let's break it down.
Okay, ultimately, it comes down to conservative underwriting. What? What did you just say, Stacey? So what does that mean, conservative underwriting? So when you're looking at a potential investment property, you're gonna do a basic financial analysis. You're gonna look at what are the rents coming in, what are the expenses that are going out, And what's left is called net operating income. Now, how much you're gonna cash flow is gonna depend on what your mortgage payment is at that point. So when you're doing your basic financial analysis to see whether this property is gonna make sense, conservative underwriting means that you're using an interest rate that is not only good today, but that's gonna be good when you close. So you have to watch what's going on in the news. If we're at a time where ultimately, you know the Fed is gonna be meeting and they've already said they're gonna increase by 50 basis points or whatever they're talking about at the time, and you know you're gonna end up closing at a time that's gonna be after that meeting, even if you got your rate locked in now, conservative underwriting means you're running the analysis of the deal as if the interest rates have already gone up to that next level. And that way, if you don't, or if you get a lower rate, yay, cool, you're good. But if it does go up, you're still good. All right, so let me give you like a real life example of this. One of our students, Teresa, she's amazing, absolutely amazing.
Rock star.
Absolutely. So she has 2 properties under contract, both duplexes, and we literally were meeting on our group coaching call the other day, and she was talking about the properties, and as we asked questions about what interest rate are you using, she talked about, well, they're gonna need some rehab. But there's also tenants in there. So I know this whole process is gonna take longer than a normal deal that she does, right? So conservative underwriting, she knew exactly what to do and she did it. So when she looked at the deal, she underwrote it at something like 8.5%, something actually probably higher than it's realistically going to be. But she did that so she could see if it did take me that long to refinance after doing the rehab, I want to make sure that the property still cash flows if interest rates went that high. And frankly, what she was doing, why she was using 8.5% is because she was thinking that she was going to need to refinance with a hard money lender. She might, with a partner, be able to refinance with a conventional lender and get it lower. But what she's doing with conservative underwriting is making sure that no matter what, even if it's worst case scenario, the deal still works. And that is how you stay safe during a time where interest rates are changing and going up. And ultimately, if you can lock these down, like Teresa's literally building a portfolio while all of her competition is sitting on the sidelines waiting and wondering what's gonna happen. And she's like, well, I know exactly what's gonna happen in my house. We're gonna build some serious wealth. And she's doing that, but she's doing it in a way that she knows what the worst case scenario is gonna be. And if that is acceptable, then it means she's got a deal. And that's how she's writing her offers and being very successful.
So the bottom line is, don't wait for a crash that isn't really coming before you get into action. What we really want you guys to understand and fully embrace is it's about your life. It's not just about the housing market. This is about your life, your livelihood, and we want you to live without fear, know your options, make decisions, and learn from them if you happen to trip up, but get into the game. Don't just sit idly by letting everything happen. I don't know if everybody realizes just what inflation does year over year over year. Just assuming a 3% inflation rate, if you took $50,000 over a 20-year time frame at 3% inflation, which we know it's much higher right now.
Right now it is.
Much higher. 3% inflation year over year over year, your $50,000 today in 20 years is only worth $27,000.
Oh my gosh.
And that's no lie. Yikes. It just starts compounding against you. If you put it into a multifamily asset, it's worth north of $4 million 20 years from now. That's a huge difference. You can't just sit idly by, because by sitting idly by and taking zero action, you are literally almost losing 50% of your money that you have today. It's fucking terrifying when you think about it.
And now that Jen has scared the crap out of you,
I just want you to be informed.
And if you guys like this video, check out our other video on what to do when interest rates go up in multifamily real estate.
So if you're still skeptical, despite everything we've shared, that's okay. That video will help you get a little bit more clarity and get into action.
See you guys next week.